Commodity funds were the only asset class that rose during 2022 while stocks and bonds fell. And this is why investors often choose them as part of their portfolio, as they diversify portfolios for just these scenarios. But choosing commodity funds is not straightforward, as they can lose value rapidly. So in this video, we'll look at the best commodity funds to sit in your portfolio for the long term. I'm Ramin, a financial educator working with Trading 212 to help you through your financial education. Please note that nothing in this video should be construed as financial advice. What are commodities? These are the raw materials that are the inputs to the global economy, from the coffee that you drink in the morning, to the bread in your sandwich, to the fuel in our cars and the fabric of our cities. Commodities fall into the broad categories that you can see here. The prices of these commodities vary based on supply and demand, but broadly they track the rate of inflation over the very long term. Fund managers who run commodity funds do not buy commodities directly. They don't have warehouses full of soybeans, for example. A much simpler way of getting exposure to the price of commodities without buying the commodities themselves is via the futures market. A futures contract is a derivative that agrees to deliver something for a fixed price at some future date. For oil in the United States, for example, a futures contract often delivers the oil at Cushing in Oklahoma. But the important thing is that by buying an oil futures contract, a fund manager immediately gets exposure to the price of oil without having to store barrels of crude oil in their office. As the price of crude oil rises and falls, so does the oil futures price. Why does this matter to you? If you buy a commodity fund such as this one from Wisdom Tree, it will buy exposure to these commodities via a portfolio of futures contracts, but this can come with an invisible cost. If we look in detail at the fact sheet for this fund, we can see that the manager is buying physical precious metals to reduce something called roll cost. Roll cost is one of the most important things to consider when choosing a commodity fund, as it can be a huge drag on your fund return over the long term. So what is roll cost? We saw that a futures contract has an expiration date, which the manager has to choose, but they can't just hold this contract forever because it will expire. The fund manager will continually have to sell one group of contracts and buy another, which is called rolling. If they let the contracts expire, they may have to take delivery of the commodity, which they definitely don't want. The price of futures contracts usually look like this, with higher prices in the future. Notice the prices are spaced further apart for short-term futures. So the roll cost, as it's called, as the fund manager sells the cheap 1-month contract and buys the expensive 2-month contract, is very high. They're continually having to buy high and sell low. If instead the fund manager buys the 5 and 6-month contracts, the prices are closer together and the roll cost is smaller. So you'll sometimes see names like long dated in the name of the commodity fund, as it tries to minimize the roll cost. Here's a selection of commodity funds which are available on Trading 212. Notice how many have words in their name, which shows how they're trying to reduce roll cost. For example, longer dated moves further out on the futures curve, as we saw previously. Roll select chooses multiple parts of the curve. Enhance chooses the futures contract dynamically to minimize cost, and physical gold avoids futures altogether by buying physical gold. What drives commodity prices? One important driver, particularly over short periods of time, is fear. When stock markets sell off, then risky commodities do too. That would include economically growth-sensitive commodities such as energy and industrial metals. Gold is special because it's a safe haven commodity, which tends to rally when stocks sell off. Gold is also driven by interest rates. When interest rates are high, it tends to weaken the price of gold because it does not generate an income. When rates are higher, people prefer other income-generating safe investments like US Treasuries. Gold, like other commodities, is priced in dollars, so a strong dollar is bad for the price of gold. Energy usually spikes during periods of political instability in oil-producing countries, as this may threaten supply. The larger the producer that is affected, the bigger the surge in the price of oil. Demand for energy is also linked to economic growth, so recessions tend to push down the price of oil and gas. In extreme cases, when demand falls very sharply, it is even possible for futures prices to turn negative. As storage ran out in Cushing, there was a brief period in 2020 when people were willing to pay to have others to take delivery of oil. Industrial metals are also linked to economic growth, particularly in China, which buys a large proportion of the global supply of metals, such as copper. Supply for these metals may also be disrupted when large mines shut down. Agricultural products are the least predictable, as surges in their price tend to be driven by things such as extreme weather or the spread of disease in animals and crops. In conclusion then, how might we choose the best commodity funds available on Trading 212? I've shown 3 groupings of commodity funds that are available based on how correlated they are. They're grouped into sterling and dollar denominated broad commodity funds, which buy a whole basket of commodities, and precious metals. Broad commodity exposure might be helpful if you think we're about to get disruption in the supply of energy or food, perhaps as we enter a period of geopolitical instability. A precious metal fund might be helpful if you're worried about a fall in the stock market, as it's a safe haven investment. Here I've shown the list of available funds and their ongoing fees. For gold, I've highlighted the cheapest fund, which costs just 0.12% per year. For broad commodity exposure, I've highlighted the cheapest fund that does some roll optimization, because it usually makes sense to avoid paying roll costs. But it's important to look at what's in each fund to make sure it gives you the commodity exposure that you want and how it's trying to reduce roll cost. I hope that's helped you understand more about choosing commodity funds and the hidden roll costs that they often have, but also to make sense of the financial jargon in commodity fund fact sheets. Please click on like if you enjoy this video, and do subscribe to the Trading 212 channel if you don't want to miss any new videos.